Good afternoon and welcome to AIADA's AutoTalk. I'm your host, Rachel Soleimani. Today, we continue our webinar series surrounding COVID-19 and the global pandemic's effect on the automotive retail market. You will all be receiving a copy of this webinar by the end of next week. Now join me in welcoming Cox Automotive Senior Economist and Senior Director of Industry Insights, Charlie Chesbrough. Charlie, take it away.
All right. Well, thank you. And thank you to everybody for joining today. I wish we had good news to share with everybody today, but it's really trying times, and it's really a historic period that we're all dealing with. And I'm hoping to provide you some information today that'll at least give you a little bit of more information on what's happening regarding the virus and regarding the economy and the vehicle market today, and leave you with a little bit of hope, or at least perspective, on the fact that as difficult as today's times are, we have had difficult times on many occasions here in the United States and in the U.S. economy. And I just want to walk people through just to kind of make folks remember that we've had difficult times, we've overcome it before, and there's little reason to think that we will not overcome this situation as well. And then I'm going to talk for about 20-25 minutes, share a few slides, and then I'll leave some time at the end for questions. If anybody has anything that they'd like to ask me specifically, I'd be happy to address those questions. But let's start off by talking about the virus itself. This is a map that's showing counties around the country and where we're finding severe cases of the virus. And you can see that right now it appears New York City is the epicenter of the virus here in the United States. I'm sure we've all been watching the news and seen a lot of the terrible footage that's coming out of New York City. You know, at this point, we've got, I think, 440,000 reported cases of the virus. We're over 14,000 deaths at this point. And unfortunately, everything we're being told is that we're still weeks from being on the other side of the peak of this virus. The president has been giving us a lot of news over the last week or so. And I think one of the key messages that he's been trying to get across is that we're going to have a really difficult couple of weeks here in the U.S. economy, as well as regarding the virus. And so that everyone should be prepared that April is going to be really bad. As bad as we thought things were in March, the data that we're going to be looking at by the end of April is going to be substantially worse. But what we have to understand is the stock market's already built in that. They're well establishing a new baseline for their assumptions. So there's not a lot of shock anymore. And that's one of the things that we had to get through as sort of the first phase of this is the shock itself. But we are looking at unemployment claims rising dramatically across the country. And this is a map that's showing where states have reported significant job losses. This is the map from last week. We just had a number announced today with more initial unemployment claims. And we actually had about 6.6 million people file for their initial unemployment claims. So for those who have not been paying attention, that's 3 weeks in a row of record levels. During the peak of the Great Recession, the U.S. economy lost about 690,000 jobs in 1 week during the worst period of the Great Recession. We lost 3.3 million jobs the third week of March, 6.8 million jobs the last week of March, and then another 6.6 million jobs the first week of April. So the job losses have just been phenomenal, really just mind-blowing, the amount that we've lost. Again, this has been expected. We knew that a lot of unemployment was going to be coming. Essentially, we've seen a massive collapse of the U.S. economy, almost about a 30% contraction in general, as the services sector of the U.S. economy has just taken a huge hit. The restaurant industry, retail trade, folks working at stores, hospitality, hotels, certainly travel, have all taken massive hits. And these are very service-oriented jobs, hourly wages. And so the economy is really trying to readjust from this initial shock. At this point, we're probably looking at an unemployment rate that's north of 10%. We have been warned by the Treasury Secretary that we could see the unemployment rate rise to 20, possibly even 30% over the coming months. So it's just to be, not to reiterate the bad news, but I think everybody needs to know the reality out there is we are dealing with a very significant crisis, and the magnitude of which really cannot be overstated. Now, one of the things that we're watching closely is consumer sentiment. because certainly in the vehicle market, very few people go out and buy a vehicle that aren't confident. And that's one of the key ingredients. If I'm going to be making a big purchase like a house or a car, I'm going to be signing up for a payment for $500-600 a month for 6 or 7 years. I have to be very confident in my economic situation, as well as the overall view of U.S. economy and my own personal finances. And so what's happened is we know that consumer confidence has taken a dramatic hit. Not only are people concerned about the virus and their health, but they're now starting to recognize the economic side of this as well, that there's real concern about their job prospects and whether their job is secure. So one of the metrics that we look at closely is coming from Morning Consult, and they do a survey of thousands of people every day, asking them what is their outlook. And what we can see here is that essentially consumer sentiment was fairly stable, just kind of moving along there in February. And then the news of the virus really hit around the beginning of March. And we saw consumer sentiment started to take a dive. And then by the second week of March, it really started to pick up. And now you can see where we're at today. If there's any good news about this data so far, it's that it does appear that we've sort of passed this initial shock phase, and that we've reached a little bit of a plateau around 80, but you can see that's down significantly from the levels we were at before. What we're expecting is that these numbers are going to continue to decline as we get through the month of April. As I said, the news is going to be really bad. Many people have suggested that there's going to be very few times, or hopefully never again in American history, that we're going to have thousands of deaths reported every day, in addition to having hundreds of thousands of job losses reported every day. So very difficult situation. But consumer sentiment is one to watch, because certainly we're not going to have a strong recovery in the vehicle market until we see that consumers are starting to feel a little bit more confident about their circumstances. And as I said, we know that this has a little bit farther to fall down. Now, one of the things that we've been doing at Cox is we've been doing surveys of vehicle buyers out there to understand what their thoughts are regarding the virus. And this is a slide that's showing purchasers who are looking to buy a vehicle within the next 6 months. And what we can see here on the left is that in the early days of March, the early days of the virus, only about 7% of respondents were saying that they were going to make any changes in their purchasing decisions, but they were going to delay it before making a big purchase like their vehicle. But we can see that as this virus has progressed, we're now well over a third of the respondents saying that they are going to delay their purchase. So again, not surprising. Frankly, my expectation is we're going to see this number to continue to rise through the month of April as we see more and more parts of the country slow down and follow this virus. And I think that's one point I probably should have made on that earlier slide, is that in the month of March, we really had a divided nation, in that we had some states that were all in and closing down. Everybody was in their homes. I'm in Michigan. We've been at home now for, I think, our 4th week. I kind of lost track at this point. But I know other states have really just started to be under lockdown. And so we had a lot of mixed data. But what we know is that by the time we get through the month of April, we're all going to be on the same page then, because everybody's going to see the impact of this virus as it goes across the country. And so some of these numbers are a little bit elevated, and that's why we expect them to be a little bit higher as the entire nation comes to realize the severity of this crisis. So when we ask people, they're going to delay their purchases, well, for how long? Well, we can see here on the right that now folks are saying they're going to delay their purchases from anywhere to 1 to 2 quarters. So up to 6 months for up to 40% of the respondents. Again, this shouldn't be surprising, but I think there is some good news in this, in that there are folks that are out there right now that are interested in buying a vehicle, but they're just holding off. And I know a lot of folks are really thinking about this V-shaped recovery, a resurgence back to the market. I think this lends support to the idea that consumers are just kind of waiting on the sidelines, and once they feel confident, they're going to get back in and they're actually going to get that vehicle. The other thing we're seeing is that consumers are starting to pull back on doing servicing of their vehicles as well. We can see in the early days of the virus, about 5% of our respondents were saying that they were going to delay servicing their vehicle. It's now up to 40%. And what's interesting is that why are folks doing this? Well, what they told us is they prefer to maintain the social distancing. And I think this is one of the new realities that we're going to have to deal with in the automotive industry, is how do we sell and service vehicles to consumers without actually having to be face to face with them, or not actually having to touch them or be near them. This is going to be a challenge, and certainly digital retailing is going to be one avenue that many dealerships are going to try to implement to alleviate that problem. But certainly within the fixed ops part of the business as well, we're going to have to figure out how do we service people's vehicles without having to have too much contact with them, because I think that's going to be the new normal. In fact, Dr. Fauci, the virus specialist that's been consulting the president, he said that just earlier today that he thinks that people shaking hands will never happen again. That's a tradition that we have in society that needs to go away. So it's going to be a different world on the other side of this. And I think the automotive industry is going to have to recognize there's changes that are going to have to happen. And certainly this idea of maintaining social distancing while providing service or selling a vehicle is something we're going to have to keep in mind. The other thing we look at is we have the ability to track vehicle sales at our dealers around the country. And this is a chart that's looking at same store sales for a couple of hundred dealers. And what we're able to do is actually look at sales that they did on Wednesday this year versus that same Wednesday a year ago. And we do this to try and monitor what has been the impact of this virus. And in orange here, you can see this is the year over year change in daily sales. And what's interesting to note is that really the strength of the vehicle market was quite strong coming into this crisis. We saw sales in January and February that looked very optimistic for a very strong year for the new vehicle market. You can see even in early March here that we were running ahead of where we were last year on a year over year basis. But of course, then this virus came and we've seen that sales have really taken a strong fall, which is not surprising. But it's now down almost 2/3 from where we were at last year. Again, if there's any good news in this, it's that it does appear that we've reached some sort of a plateau, that we've reached sort of the initial shock phase of this virus. But there is potential for even more downside because, as I said, this is, we still see more and more of the country starting to shut down. More and more dealerships are closing, not being allowed to sell vehicles. That's certainly the case here in Michigan, where a dealer can't even sell you a vehicle, even if you're pounding on the glass outside. Everything's shut down. And more states are doing that. And so it's very possible that this number is going to continue to fall as we get into April. We also look at same-store sales on the used side. And again, you can see it's following a very similar trajectory as new. And that's a little bit surprising. Our expectation is that we might see the used market actually hold up a little bit more. Certainly it would be down, but it's down essentially the same amount as the new side of the business. But our thinking is that used is generally a lower price point. It shouldn't suffer quite as bad as the new market because it's not, the prices are substantially smaller. But what we think may be going on is that the first wave of the job losses that we've had have been these hourly service workers, and they're probably our primary used vehicle buyer, not necessarily for the off lease or the gently used model year 0 to 4 type vehicles, but even older vehicles. And so it could be that they're on the front lines of this virus, and that's why we're seeing the used market down so much. Again, our expectation is we're going to continue to see this fall as we get in further in through April. The other thing we're able to monitor is credit applications. And this is a chart that's showing the year-over-year change that we've seen in credit applications for large DMAs around the country. And you can see we've highlighted in here where we saw markets that had huge drops in credit applications. And in red, those areas represent a change of about 78% decline in unique credit applications. The areas in yellow, which is a much larger portion of the country, show about a 39% decline in credit applications. And of course, there's some green markets which are actually holding up pretty well. In fact, there are some markets we actually see year-over-year sales are a bit higher, although they are small markets. But about 5% of the market is looking at green, where we're seeing just a very mild change in credit applications. All told, the yellow represents about 80% of the new vehicle market. And what's likely to happen as we get through the month of April is more and more of those yellow areas are going to become red as more and more consumers are going to pull back in the marketplace. The other thing that we're watching closely is what's happening at the used car auctions. Manheim auctions are closed for the live auctions of actually being there in person, but they are open for digital auctions. The volumes are down quite drastically on a year-over-year basis, but they are open and they have been operating. And what's interesting to note here is that this chart is showing how a 3-year-old used vehicle, what its value is at the beginning of the year, the first week of January, and what its value is by the end of the year, week 51, 52. And we know that there's natural depreciation as the vehicle ages. Uh, and what this tells us is sort of the residual value. How strong is the demand for this used vehicle out there at the auctions? And what we can see in purple here is that the pace that a typical 3-year-old vehicle was on was reminiscent of how we were doing back in the 2014, 2016 time period in the used market. And that was in the early stages of the Great Recession recovery, and the vehicle market was incredibly hot. And what we are seeing in 2020, before this virus came, is that we were following a similar trajectory, which meant that there was a lot of demand for these 3-year-old used vehicles, that they were really holding their value. But you can see once this virus kicked in, we've really started to see a deviation. And this is really one of the big question marks out there for the vehicle market, and certainly for a lot of the finance companies, is what's going to happen with these residual values. And I have to say, for these presentations that I've been doing, that's probably one of the most frequently asked questions, is what are the rental car companies going to do? Because they're sitting on a bunch of inventory that they could take to auction and try to sell, which would drive prices even lower. And of course, we know that repossessions are likely to increase here as the virus, the ramifications of that last through the summer. That means more volume coming to auctions as well. That's going to put more downward pressure on prices. So we really are an interesting stage where there's going to be a lot of downward pressure on used vehicles at auctions. That's just something to be aware of. It's not all bad news out there, though. We are starting to see in some of our data some early signs of hope. And our Auto Trader shopping data, as well as our Kelley Blue Book data, is suggesting that we're seeing tremendous activity from folks that are at home shopping online, and they're shopping for new cars. People are very interested in vehicles, and we're seeing a lot of activity on our shopping sites. The other thing that's very interesting is that we're seeing a lot of interest in the new 0 for 84 financing offers that manufacturers are offering. In fact, we've seen, I think some data that we've seen is that almost 40% of retail sales on certain days have been almost entirely these 0 for 84 offers. So they're really gaining quite a bit of interest. I think it's likely that we're going to see the industry have more and more companies get aggressive with these 0% financing offers and offering them across more of their portfolios as opposed to just sort of older vehicles. The other thing that was just pointed out, that we've had to revise our expectations for the vehicle market this year. We're now expecting that the new vehicle market's probably going to fall in the range of around 12 million this year. We started the year with an expectation of around 16.6 million. So again, it's going to be a substantial fall, almost 25%. And that's something I think everyone has to readjust to, that it's going to be a new reality out there. The other thing we're keeping an eye on is days supply. And this is looking at new vehicle days supply. And you can see that it started to tick up, suggesting that dealers have too much inventory on their lots. But again, this might be a little overstated right now. We're really in the early stages of this virus, and we know that demand has completely dropped in many markets across the country. But we also know that this time around, the manufacturers themselves have limited supply. The factories around the country, many of them, in fact, I think most of them, are now shut down and not producing. And so what normally happens when we have a recession is that there's usually a collapse in demand, but the manufacturers keep building these vehicles. They keep forcing dealers to buy inventory that they probably don't need. But this time around, because this virus is impacting both demand and supply, we may not have that inventory buildup like we've had before. We're sort of at the early stages of it. It's certainly something to keep an eye on, but it may be that the supply side will contract a little bit as well because of these factories being closed down. Now, one of the things that I think it's important to point out is that we need to kind of rethink how we view the marketplace, and the consumer out there is taking a double hit. because they're going to get hit sort of on the economic side. Uh, the shock to their portfolios and their 401ks, certainly the stock market being down is a real eye opener for many people. But of course, their own economic circumstances and whether their jobs are impacted or whether they have to take a pay cut like many companies are doing today. So in that environment, we would expect that high priced products are going to be particularly vulnerable. High performance cars, high end luxury cars that have very high transaction prices. That's going to be very difficult for many consumers. They're going to be rethinking what they're looking for out there in the marketplace. But the other whammy they have to deal with is credit availability. Now, right now, we're not hearing stories about credit not being made available, but that's something that could change rather quickly. And one of the things that we got to keep in mind in a crisis is that there's always a flight to quality. And just as we saw in the global financial market, as this virus was hitting, there was a real flock to the US dollar, that everybody wanted to own US treasuries because that's the safest debt you can have. That the Americans are always going to be paying their bills. So everybody wants to own that when the world's, when it's all hitting the fan. Well, we're going to expect something similar in the automotive lending market, that there's going to be a flight to quality. Everybody's going to want that 800 FICO score customer. That 600 FICO score customer, not so much. And this is also showing us the average APR by different vehicle segments, with the APR sort of a proxy measure of the FICO score of the underlying customer. That the lower my FICO score, the higher the interest rate that I'm going to be charged. And what we can see here is that subcompact cars, compact cars, even though they have the lowest price points in the industry, their customer base also has the lowest FICO scores. And if there's a flight to quality and not as much credit being made available, we may find that many of these customers may not get the credit approval because of their questionable FICO scores. And as I mentioned earlier, that the hourly workers are really on the front lines of the job losses so far. They may actually be the primary buyers, at least in these new segments, of these lower priced products. The other thing to keep in mind is that consumers are likely going to be thinking about ways to save money as opposed to ways to spend money. And so consumers may be looking for different types of products that you have available, and they may be doing some segment switching or some size switching. And to give you just to illustrate what I'm talking about here, on the left here in blue, I'm showing the monthly payment premium to buy a crossover version of a vehicle versus the car version. So if I'm looking at a subcompact car versus a subcompact crossover, well, that crossover on average is an $80 a month premium that I'm going to pay over that subcompact car. And so for a lot of consumers, you think, do I want the Ford Focus or the Ford Escape? Underneath the hood, it's pretty much the same vehicle. It's just a different shape up above. Well, that's a pretty big premium that you're asking a lot of consumers to pay, and they may no longer be willing to pay it. And when you think about it from a size perspective, if I was looking to go from a mid-size car to a full-size car, that's about $122 a month on average, in addition to my monthly payment that I would have to pay. From a mid-size to a full-size pickup truck, it's almost $200 a month. So again, it's just something to keep in mind that consumers are going to be thinking about ways to save money, and that may cause them to pull back on some of their spending and their product preference. Now, there is going to be demand out there, and the only guaranteed demand that we know about are going to be off-lease vehicles at this point. And one thing that we know is that back on the leasing that was done in 2017 and some in 16 and some in 18, we estimate there's about 4.1 million off-lease vehicles that are going to be coming back to dealers this year. Highlighted here are some of the biggest players, and you can see there's a little bit of, this is monthly data, there's a little bit of a crescendo that over the summer months, that's when the most off-lease vehicles occur. So it does time itself real nicely for a nice, robust Q3, July, August, September, when a lot of off-lease vehicles are going to be expiring, and these folks are going to be back in the marketplace looking for transportation. Now, this is a consistent 340,000 people a month. It's going to be very competitive, a bunch of conquest and loyalty programs as the OEMs are going to be fighting for these buyers. And these are your choice buyers, right? These are your 800 FICO score, your good FICO score customers. So it's going to be a real battle for these. And really just the same slide, but really just looking at the luxury market. And certainly we can share these slides if you want to look at it further. but it's really just to illustrate the point that there is going to be demand out there, but you're just going to have to be fighting with other manufacturers to get these folks. So I just wanted to kind of talk a little bit about the expectations and why people are thinking that a V-shaped recovery is very possible. And I think there's a lot of room for hope as to why we could recover from this calamity rather quickly. And a couple of points I just want to make. One, unlike previous recessions, the economy is falling from a position of strength. The U.S. economy in February of 2020 is probably going to go down in the history books as maybe the pinnacle of when the U.S. economy was at its strongest point. So we are not falling from a position where there's a cancer in the economy, where banks or their finances are all messed up, the consumer finances are all messed up. We're not in that situation. So that suggests that we could rebuild rather quickly. We also should feel confident that the government has made a massive investment into this crisis. We've had $2 trillion in spending approved by Congress, an additional $4 trillion in monetary spending from the Fed, and probably more to come. In fact, the Fed just announced another $2.3 trillion small business loan program today. There's talk of an infrastructure bill finally from Congress, and there's even been talk of a cash for clunkers program at some point. And I think we should feel confident that the government has made such a substantial commitment during the depths of the Great Recession when Wall Street was on the brink of collapse. It took months for Congress to negotiate the bill that they finally came up with, and it was only for $800 billion. Well, this is a substantially larger amount, and they did it within days. So I think we should feel confident that Congress is really on, as crazy as it might be, they're all together on this one. And I think the other important point, as I mentioned earlier, is that U.S. Treasuries remain a global safe haven. People are going to be buying U.S. Treasuries. They want to lend Americans money. That means that we're going to be able to borrow money for relatively free for an extended period of time. And that means there's going to be a lot of support to make additional investments in the U.S. economy. And the other thing I just want to point out is that we've got cheap gasoline. And I know nobody can drive anywhere right now. Everybody's stuck at home. But nothing makes consumers happier than cheap gasoline. So once we get the okay that we can leave our houses and drive around, people are going to be filling up their cars for 20 bucks. And that's going to go a long way to making people feel good and getting that consumer confidence back again. But there are some obstacles that we have for this recovery that are unique to the industry. One, vehicle prices, at least on the new side, are at a peak. And we've been getting away from smaller, lower priced vehicles. We've gotten away from car segments. So people that are looking in the marketplace for a new vehicle but not wanting to spend a lot of money, there's not as many product choices as we had in the recovery from the last Great Recession. And as I said, credit availability may be threatened. We know subprime delinquencies are already elevated. They are likely to go higher. And we know that car defaults were pretty minimal during the Great Recession. People were much more likely to default on their home loan or their credit cards than they were their car loan because they needed that transportation to get to work. But what we don't know is whether that assumption holds this time around. It's a little bit different, right? We're all stuck at home. There's a lot more telecommuting. Maybe I don't need my vehicle as much as I needed last time, so that I might let my loan default. That's just something we got to keep an eye on. And I think the other interesting obstacle is going to be the competition that may be coming from the gently used market. As I said, consumers are going to be looking for value out there. And when I can get a new vehicle for price X, and I can get a gently used version of that vehicle that's just a couple years old for 50% less, boy, that's going to attract a lot of buyers into the used market that might have bought new otherwise. So lastly, I just want to give you a little perspective that as crazy as the times are today, and everyone's saying it's never been this bad, well, I propose that, yeah, we've had bad times before. And I pulled out here the Time magazine cover from October 2nd of 2008. This was in the wake of the Wall Street financial collapse, and Time magazine declared it the end of prosperity. Warren Buffett declared it an economic Pearl Harbor. Ben Bernanke, the chairman of the Federal Reserve, called it the worst financial crisis since the Great Depression. The stock market fell 50%. Home foreclosures spiked. Over 8 million jobs lost. And yet since that time, the vehicle market increased 63%, and the Dow Jones was up over 200% since that declaration. And we've also had other bad times. And I think one of the recessions that probably most resembles the period that we have today, although we are in unique ground, was the OPEC Oil Recession. In October of 1973, the OPEC countries, oil producing countries, announced that they will no longer sell oil to the Americans because of our support for Israel. That led to an immediate a shortage of gasoline across the country. We had lines at gasoline stations, oil prices and gasoline prices spiked. It led to a huge decline in the US stock market. Inflation skyrocketed, unemployment skyrocketed. And in addition to all of this, we had a government in chaos. The vice president had to resign because of a bribery scandal. Watergate was dominating the talk in Washington. And of course, we were in the 8th year of the Vietnam War, a highly unpopular war where there was protests going on around the country. And look at what happened in vehicle sales. They fell dramatically from 1973 into 1974 and 75. And then they started a very robust recovery through the 1970s. So it took a little time, but we did come back. And then we also had the double dip recession of the early 1980s, when we had double-digit unemployment and double-digit inflation. So it's kind of the double whammy called stagflation. And it was such a major problem in the US economy that the Federal Reserve had to raise interest rates to 20%. I mean, imagine buying a home loan or a car at a 20% interest rate. Stock market fell dramatically. There was real concern about the US solvency because we were spending way too much money. Unemployment rate took off. And on top of this, we had a foreign policy crisis going on. We had hostages in Iran, a Moscow Olympic boycott, the arms race with the Soviet Union. And of course, the president himself had an assassination attempt that very nearly succeeded. Really just a very chaotic time. And yet look at what happened to the vehicle market. We bottomed out in the summer of 1982, and then it started a very robust recovery that lasted throughout the 1980s. So I really just wanted to bring up the previous recessions, that even though the current recession that we're going to be going into is different, I think it's important to point out that the US economy has a history of having shocks or issues that address the economy that cause huge problems, but the US economy has always rebounded. And I think there's very little reason to think that that's not going to be the same case this time. The only question we're really wrestling with is how long do things stay bad? And I think there's a lot of reason to think that given the investment that we've got from Congress, given the fact, as I mentioned before, that we're falling from a position of strength as opposed to some sort of cancer in the overall economy, that we could see the U.S. economy as well recover quite nicely. Probably not this year, but certainly as we look into next year, the market should be substantially better. So those are my comments. I'll take a quick look and see if any folks have any questions for me here. Let's see. One comment I just want to make is what's going on in the oil market. It's interesting that oil prices have fallen dramatically during this crisis. In fact, we're down close to $10 a barrel for oil, far below the 140 a barrel we were looking at just a little less than 10 years ago. That's going to be a big boon for consumers out there. That's real money in consumers' pockets when they're paying, $1.50 or less for a gallon of gasoline. As I said, that's going to be a real plus for consumers getting their confidence back and feeling comfortable about their own economic circumstances. But for the U.S. economy as a whole, it's a big negative. Because the U.S. economy is now an energy exporting country, the fact that oil prices have fallen so far is actually a negative impact on the U.S. economy now. The gains to consumers no longer outweigh the losses that we're going to see on the economic production side because we have such a large energy sector today. So it is something to keep in mind that even though we all enjoy cheap gas, it might help us individually, but it's not necessarily in the best interest for the whole country. So, and the other thing I just wanted to point out here, just looking at some of the questions that you guys have sent out, I think the expectation that we have to go forward with for this virus is that the second quarter is going to be terrible. I don't know what other words would be best to describe it, but it's going to be historically bad. But when we get to the third quarter, the expectation is that we're going to be sort of post this initial wave of the virus. Many more businesses, in fact, most businesses will probably be open, certainly by July 1st. that's certainly the expectation, that economic activity is undoubtedly going to be higher. The real struggle that we have right now is that can we get the economy opened up again before we get into sort of the next wave of financial difficulties that could result. When people are no longer able to pay their rents or their mortgages or their debts, when businesses have to lay off because they can't meet their own debt obligations, that's when this could turn into a financial crisis, and that's certainly what we, I think, want to avoid at all costs. Uh, and at this point, you can see from the news from Wall Street is they're fairly optimistic that we're going to be able to do that, and that's why the Wall Street, the Dow Jones, and other indexes have been up substantially this week. There's a little bit more optimism out there, so I think we should feel good about that. Once someone asked, I talk a little bit about car values and with rental cars and auctions. I think there's a little bit of a game of chicken that's probably going on right now. Nobody wants to sell their inventory. Everybody is hoping that we're going to be, right back to the way things were on March 1st. And so they've been holding back. But I would make, at this point, I think it's going to be very important for businesses around, not just automotive, but all businesses, to understand that the month of April and possibly May as well, cash flow is going to be critical. And you may want to rethink keeping all of the inventory that you have, and you may want to think about selling some vehicles possibly at a loss to consumers or whoever you may have coming to your dealerships just to get the cash register full. Because, car buyers are going to be unicorns, here in another week or two. You're not going to see many at dealerships. And, there's almost a mantra that could be said that no customer should leave without a vehicle. April and possibly May are going to be very lean months. And so you're going to want to make sure that you have the financial capability to get through that. As I said, once we get through that and we get into June and July, the circumstances should be substantially better. And let's see here. That one question is, what will the impact be of low oil prices be on future electric vehicle sales? Well, certainly it's not going to help, right? One of the things that was always kind of pushing consumers to look for electric vehicles is the cost savings that they would bring from having lower gasoline costs. But what we know is that with cheap gasoline like this, those cost savings are going to be minimal. So I don't think it's going to help electric vehicles. My expectation would be that when they do a cash for clunkers program, that they're somehow going to try and target electric vehicles to try and get folks to buy more of them. That's what we did during the Great Recession when we did cash for clunkers. The idea was to bring in your old gas guzzler and buy a new high mileage vehicle. Well, a certain type of program seems likely to happen this time as well, except the difference is we don't have a lot of of high mileage cars anymore, at least not that the Americans are producing. And so it seems to me that they may need to be a little bit more broad in what vehicles would qualify for a cash for clunkers program, but I'm kind of speculating on that right now. Let's see here. I don't really see any other questions that would be pertinent. I guess the only other comment. Oh, I'm sorry. Go ahead.
No, I was just going to say, thank you for your time. I know that you're really busy, and this is a chaotic time for you, and I just want to reiterate how much we appreciate having you on. To those asking for a copy of the slides, you can email me at S as in Sam, OLIMANIR at AIADA.org for them. And then we will also be sending out a copy of the webinar recording by early next week. To continue with our COVID-19 webinar series, this is only supposed to be a three program event, but as the news continues to come in, we at AIADA continue to seek out relevant topics to present to you all. So join us back here next Thursday, April 16th at the same time to learn about shifting from in-person to digital, how the pandemic is forcing a new way to do business. So be on the lookout for promotions on how to register. For more information about AIADA, visit AIADA.org. Thanks for joining us, everyone. Stay safe and healthy.